What's going on, guys? Bryant here. Today is Wednesday, November 6th, 2024, and it is the morning after the U.S. general elections. As we can see, the market has gapped up, and we are currently at all-time highs as the market is up over 2%. Before the gap up, the gamma exposure profile for this week did not really show that much sentiment to the downside. In other words, I didn't see the usual amount of hedging that we would normally see before such a major event. We'll take a look at this gamma exposure profile in greater detail later in this video, but this is the snapshot of it 1 minute after the market opened for this week. This is the combination of every expiration for this week. So Monday, Tuesday, Wednesday, Thursday, Friday. This is my notes at the start of the week here. If you guys are long-term subscribers of this YouTube channel, then you know this is how I start my week. I take a look at the gamma exposure profile, I map the key levels on my chart, and I kind of come up with a blueprint or some sort of a game plan for how I'm going to approach the week. We'll take a look at a couple trade examples that I have running. One was an ES broken wing butterfly, and then the same with a NASDAQ broken wing butterfly. So that's them on option strat. We will take a look at them in Thinkorswim. However, I think option strat is a great universal tool for those of you that are not on Thinkorswim. So this is the ES, and then this is the NQ here. I have the trade queued up for in case I want to close it, and then showcasing you guys an example of what it looked like when I opened. This is the debit in which the trade was filled for. The option strat P&L is not entirely accurate as there is a delay on option strat, but this is just an example as I mocked it up in here before I started recording this video. The ES trade was opened before the NASDAQ trade, but for the most part, this is just for demonstrative purposes and to show you guys with a better or cleaner user interface for those of you outside of Thinkorswim what the trade was. And again, why I decided to be long, it largely came from what I saw in the gamma exposure profile. Now, as we look at these side by side, we have the SPY on the left, 15-minute time frame, and here we have the SPX 15-minute time frame on the right. For as long as I've been trading, I use the SPY as my focus when analyzing the S&P 500. I trade the ES, I trade the MES, I trade the ES options, I trade the MES options, I trade the SPX options, I trade spreads, I buy options, I sell credit spreads, I trade all different types of options, strategies, and futures. But the SPY is the one main instrument that I use to analyze and gamma exposure outside of the 0 DTE. So in other words, if I'm looking to analyze the market from a 0 DTE standpoint, then I focus in on the SPX gamma exposure profile. But for the most part, anything outside of a 0 DTE trade, I'm mostly analyzing the SPY and the SPY gamma exposure and the SPY options chain. So let's take a look at a couple clues that the market gave us regarding which direction it was looking like it was going to go this week. There was no way to know with certainty around a binary event such as the elections because the market very easily could have been down 2% today. However, if we take a look at the gamma exposure levels for this week, there wasn't really much intense sentiment to the downside. We had this key strike right here of 568. So let's just take a look at my notes at the start of the week here. And this is Monday, about 40 minutes after the market opens. I start off every week again by just analyzing this gamma exposure profile from quant trading app here, just selecting the expirations for the week, hit submit. Then I get this profile and I keep it up for the full week in case I ever want to go back to see if there's anything in which I missed. The current price of the SPY at the start of the week, the closest strike price was 571 as the market was at 571 and 24 cents. And we see right here this massive gamma strike of 570. This is interpreted to me as a strong support level for the week. If this level is to break, then I think where will it go next? The first thing I noticed is that there was not really that much open interest below it. As we can see, these blue strikes right here are lit up on QTA as it is what I call the open interest heat map. It is highlighting the strike prices that have a lot of open interest. As we can see, this is a deep blue color here because this is a strike that has a lot of total open interest. In this case here, over 100,000. It is combining the call open interest and the put open interest. This strike price has about 50,000 open interest, so that appears to be the second highest open interest strike. And then we can see this is 32,000, so that's in the higher tier. We have 38,000, and then it gets lighter and lighter, 25,000, 25,000, 26, and this is relative to this week. So in other words, next week there might be a strike price that has over 200,000 open interest. That would be the strike price that would be lit up as the darker or the deeper blue color here. Next, these little markers or indications are letting us know if the strike has the most open interest. It is highlighting it right here. This is the strike that has the highest amount of call open interest right here, so that's why this bubble is showing up. This green is letting us know this is the strike with with the most positive amount of gamma exposure. This has been covered in a bunch of videos on my YouTube channel. I'll leave a link in the description to how I assess every week, and it is more of an in-depth, detailed breakdown regarding how I approach every single week. And this has led to a simplicity in how I approach every week. In other words, I like to try to come up with a blueprint or a game plan. Now, as I scroll down here and we turn off the absolute GEX, the first thing we're taking a look at is this is the current strike price for the SPY. This already is a very strong strike. As we can see, it is sticking out right here. If this level was to break, the next question I'm going to ask myself is, where is the market going to go? In this case here, this looks to be the next magnet. It's 568. It is the next strike that has a decent bump in negative gamma. This is what I refer to as N3. So this is N1. N1 just means it is the strike with the highest amount of negative gamma. N2 is the strike with the second highest amount of negative gamma. And then N3 is the strike that has the third highest amount of negative gamma. So that being said, this is N1. As we can see, this is the biggest red bar. This is N2. It is the strike price with the second largest negative gamma. And then we have this one right here. This is N3. This is the strike price with the third highest negative gamma. The amount of gamma exposure to be exact is over here, but that number is irrelevant to me. So this is negative 50 million gamma. This is over negative 150 negative gamma. This is about negative 75 million negative gamma or so. The exact number, if we hover over it here, we can see is negative 78.5 million. This is negative 172 million. And then this is negative 57 million net GEX. The exact number is irrelevant to me. I'm just paying attention to these big bars, and then I'm marking them on my chart, and I share them here at the start of every week. But any trader can do this within Quant Trading app, and this is what we see here. Here's N1, here's N2, and here's N3. So before price action gets to any of these key levels, we want to be aware of where they are on our chart, as that can help prepare us for the week. So for this week here, these are my notes. This is week number 45. I've been doing this for a couple of years now, and pretty much for the majority of this whole year, I've been sharing it every single week, because at this point, for as long as I've been trading, I don't know if there's a simpler, unbiased approach to every single week as a trader. And to be successful at almost anything, you want to have some sort of routine and some sort of discipline, and you want to have some sort of a plan. So this is how I plan every single week. It is the general elections. In previous videos, you guys know I always like to start with what are the news for the week, what are the major catalysts to be aware of. We have the consumer confidence report, we have the GDP report, but of course the most important catalyst for this week was the US general elections. We also have earnings for this week, so that's the news. So this is just to better prepare us around what time we can expect there to be some sort of major move in price action. Now, we are aware it is the general elections for tomorrow, because again, this is from Monday, so yesterday was Tuesday and today's Wednesday. There does not appear to be much hedging below 570 this week, which I would have expected there to be more. It's almost as if the market isn't expecting much volatility relative to past major events. What made me say that is because I'm just going to turn back on the absolute gamma for a second here, because that's going to be important also for the analysis. But we can see there's a massive amount of absolute gamma here. There's a massive amount of negative gamma here, but then below it it just looks like a dead zone. There's nothing really here, and that's strange, because this is such a major economic event. This is the election for the US president for the next 4 years. You would expect investors to be hedging. In other words, you would expect there to be some massive negative gamma, maybe down here, maybe even down here we would see some negative gamma. We'd probably see some spikes in absolute gamma here, some spikes in absolute gamma down here, relative to past events like the CPI report or any type of major jobs report. Or maybe if the Fed Chairman Powell is holding some sort of press conference, we would see some sort of hedging, and that would show up in the gamma exposure by way of seeing massive negative gamma strikes or a lot of absolute gamma. If we just take this chart right here and we split it down the middle, we can see already that there is a spike in absolute gamma here. There is a spike in absolute gamma here. And then on the downside, below 570, it just seems to be pretty dead regarding absolute gamma, and it seems to be pretty flat regarding the negative gamma that one would expect. So A, we know the date in which there is the event. It is the general elections. B, we don't see a lot of hedging. We don't see a lot of negative gamma, and we don't see a lot of put open interest. So one can start formulating some sort of idea that, hey, the market might not go down this week. So the next step is going to be, well, if you want to be long, where will you get long? In a case like this, the longer I've been trading, I generally will just start to build the position with a small size, and then we'll try to time a better entry for larger size, or if I get confirmation. But for the most part, the longer and longer I've been trading, the more and more I realize if you have a really great idea, or you have some sort of good idea and there is some sort of data or information backing it up, just get started on your position and don't be so picky and nuanced with exactly where you're going to enter. Just start building the position and manage your risk accordingly by using a position size that you are comfortable with. With the market starting the week at 571 and massive supports reading at 570, this is already a good sign to me to maybe just start building a position. The next level that reads as support to me is 568, because below here there really isn't that much negative gamma, and this is where the negative gamma spikes up for a bit, and this level should hold. So in my notes, I try to be as unbiased as possible whenever sharing anything, because I don't want to influence or affect any other trader's decision. But for the most part, if the SPY can hold the 573 to 574 zone, then I would expect 580 to be an easy target. Now, why would I expect that to be an easy target? This right here, the same way to the upside, this is where we see a zone of positive gamma. If the SPY can hold above this zone, it just looks like it would naturally gravitate towards the P1 strike, which is the strike price that has the highest amount of positive gamma. We already know it's a key area of interest, as there is massive amount of open interest here. There doesn't really appear to be much major levels in between, so it just looks like it will be on the fast track up to this level. This is the zone that it has to hold above, because this is the area, as once it enters this area and it can hold above, it is in the zone of positive gamma territory. I like to split this right down the middle here also. If we see, this is where all the negative gamma is, and then this is where all the positive gamma is. That's why on my charts, when I share these levels at the start of the week, let me actually just, this is the live chart here. This is the zone that's drawn out. Here's 573 to 574. If the markets can hold above this area, then I would expect it to go towards 580. Look at the type of price action that occurs as we got to this area, 574. Indecisive candle, doji candles, consolidation. It's pretty choppy around here, because that's the way these algorithms are programmed to trade around these key strikes. It's almost as if the decision has been made at this point regarding which way the market is going to go. We can see this a few days in advance just from being able to understand and analyze this. And obviously this comes with a little bit of experience, but that's why I've shared at least 25 videos over the year on this exact profile, this exact concept. Is the same reason within QTA you guys have seen me share this every single week. I'm not sure if any of you guys are even seeing this, because there hasn't been much feedback regarding this, but for majority of this year, the game plan has essentially been laid out in this profile every single week here. So then we have, if the SPY can't hold 570, because you don't want to lean too much in one direction. You always want to ask yourself, if I'm wrong, or what can happen if the market goes the opposite direction. If the SPY can't hold 570, then there's room for it to go lower, but it doesn't look like it would stay down. Again, trying to be as unbiased as possible, but it's very hard to not get excited when you have this much clues showing that the market wants to go in one particular direction. If it dropped down to a strike like 565 and the VIX did not go much higher, or we see some VIX SPY divergence like this, I'll leave that for another video, as I've covered that in other videos, then I would expect the SPY to bounce right back up to at least 570, and if it reclaimed 570 in a case like this, 580 would be the likely targets. All signs, in my opinion, are targeting 580. Between 570 and 573, it just looks choppy. So 570, 573 is choppy. This is all a pretty choppy zone here. It's not really clear on the direction. I just got filled on another position here. I'll check on that after I'm done recording this video. But for the most part here, this is our level in which I would see there to be the last line of actual support. But if that level broke, I didn't leave any notes or anything down here, because I'm not really thinking it's going to go much lower. But I'm not going to ignore the fact that these are levels that did have a spike in gamma exposure. In other words, if we did get down to 565, we can see that this is where this group, this next zone of negative gamma essentially ends. And then we can see it's pretty pretty low until we spiked back down at 560. But that makes sense. That's every $5 in the SPY. There's going to be some significance in the options chain. So we will see that correlation within the gamma exposure. But below 565, we can see then the open interest really just went flat up until we got down to 560. So I wasn't really looking this far down. This would have been about 2% drop in the markets. Wasn't looking down here because the other dimension in which we have is the absolute gamma. So we can see that around this zone here, if we turn off the net GEX, around this zone here, so from 570 all the way up until 572, these are the strike prices that have the high amount of absolute gamma. So I interpret this entire zone as a choppy area, and at the same time it looks like a massive net for price. So this is the current price of the SPY. It would take a lot more energy, a lot more selling pressure to break below this level, especially if there's no other magnets down here. It looks like the magnets are up in this direction. And this is essentially the last strike that has a lot of absolute gamma. It's right here at 568. So that's why 568 is that last strike that's marked off here as significant. It's the last labeled strike as the third highest negative gamma strike. It's also the zone in which I drew the negative gamma around this area, because that is the area of negative gamma to be concerned with, in my opinion. Below here, there isn't really much negative gamma. I've been leaving the levels up from each previous week. As you guys can see, this was the zone for last week here. And again, this is shared at the start of the week. So this is on Monday before all of the price actions unfolds. We can see how price action is choppy around these absolute gamma strikes, which is the purple levels that we see on my chart. It's generally going to be choppy around them. Generally, whenever we hit the high negative gamma strikes, unless we see increases in implied volatility, then price action is not going to go much lower. Speaking about implied volatility, the VIX is the proxy that I use for implied volatility. In other words, if the VIX is rising, then I read that as implied volatility is also increasing. And if the VIX is decreasing, then I see that as a sign as implied volatility is also decreasing. What we noticed from last week Thursday is that the VIX was in a downtrend right here. We can see that it was struggling to go higher. Every time the markets did make some sort of an attempt to go lower, the VIX did not have the same follow through. So I'm actually going to clear this chart and let's look at the VIX and the SPY side by side. And this is something I believe I shared in QTA. Let me see if I could find that. Right here is the first sign last week here. We can see that the SPY went lower right here, and the VIX did not go higher. The VIX went lower. We can see that this is a multi-top or a triple top, depending on how you do your technical analysis. In other words, if we drew this level here horizontal, we can see that 1, 2, 3, that is a triple top. It's 3 times the VIX came up to this 23.25 level and it couldn't break higher. But this is the same day here on the Thursday. So if we take a look at Thursday, the market was going lower. It had this scary sell-off right at the end of the day in which it broke 570, and 570 was the key strike for last week, but there was no follow-through. It was essentially just a fluke or some sort of a fake out that others might call it. But the sign to me was that the VIX did not go higher. The VIX actually went lower, lower, and lower, as we can see here, even though the SPY was going lower and lower and lower. That is not the recipe that we see if the market is going to continue selling off. So that was the first sign, for me at least last week, of an early indication that, hey, it doesn't really look that people are that worried, or massive investors or institutions are that worried about the markets going much lower. And then on Monday, we can see the market did go lower here. As we broke the 570 level again, we did puncture the low from Thursday, but where was the VIX at this time? It did not go any higher. It was still continuing to go low. So a couple of these signs here, a couple of these clues, these are some of the core principles regarding how I approach every single week in the markets. It is just based around the gamma exposure. Obviously, I'm leaving out a lot of other confluences that I take a look at, such as the quant trading app weekly levels, the quant trading app intraday levels, and some of the other gamma exposure levels. There are additional tools and there are additional confluences, but for the most part, this is enough to formulate some sort of a trading strategy or some sort of a trade idea, and then determining where you're going to enter your trade. In other words, an entry for this week is Monday at the low. If you're someone that likes to buy on supports, this is the support level. What do we also see? We get the hammer candle, or we get something like a hammer candle that I always mention to pay attention to. If you see a hammer candle forming at support, for any of you that have been on any of the QTA price action webinars that I've hosted, I always hold a section or a segment in which I go over trading basics and paying attention to on support or on resistance if you see a doji or if you see a hammer candle. In this case here, there's increased volume coming down to this area of support. We can see that the selling pressure is slowing down. Buyers show up. That is one indication. Okay, great. right? Imagine you see that, but you're still not sure. What do I always say is the next best thing? Maybe a 50% retracement from that. So in that case here, you're not sure because you're not an aggressive type of trader. You saw the hammer candle, we're on support, you decide to wait. Well, let price go, let it exhaust itself a little bit, let it pull in. If you see it pulls in and it forms a 50% retracement, and then you see buyers show up again, you see dojis, you see hammer candles, you see long wicks showing up on these candles, that in a sense is your second entry. If you still are not sure if that is a good entry, what's the next video or the next thing that I've highlighted over the past 4 years on this YouTube channel? The gap up over the 2-day anchored VWAP. Do we have a downtrend? And then do we get a gap up the next day over the 2-day anchored VWAP? This right here was yesterday's price action. This is our 2-day anchored VWAP. This is our downtrend. It technically started from a few days prior, but let's just use this trend right here as it's very clear to see. What happened yesterday is the market gapped up right over the 2-day anchored VWAP. It also gapped up over this downtrend. That means if you're entering your trade anywhere here, you know where your stop loss can be. It can be a close below the 2-day anchored VWAP, or it can be a close below the previous day's low, or it can be a close below the previous day's most recent pivot low. And that might sound a little bit confusing, as entries and exits and risk management and all those different components of trading is very nuanced and specific to each trader or each individual account size, each trader's risk parameters, and so forth. But for the most part, I just pointed out multiple potential opportunities or entries that repeat itself over and over again. If at the start of the week you know 568 is a major gamma strike, you're just sitting back and waiting to see if the clues that you normally would look out for, if they play out. If price action drops down to here and you see that wick, boom, you remember that from the last time because it played out exactly the same way. If you see increased volume, boom, you've seen it play out exactly the same way. Then if you see price action bounce and then retrace, do you see a 50% retracement? It's played out exactly the same way thousands of times. If the following day you see a downtrend and then the market gaps up over the 2-day anchored VWAP, you've seen it thousands of times, or you've seen at least at this point 10 videos or 10 instances and references in which I've showcased the exact same thing. Then you can start building a framework in your mind regarding what criteria you're looking for when you're deciding if you want to take a trade or not. Analyzing the gamma exposure is a massive edge, and I like it because it fits my style regarding how much time I have to actually spend looking at the charts. So at the start of the week, it takes less than 15 to 30 minutes for myself to really come up with a game plan, analyze it, and then I'm just following through with waiting to see what price action is going to do around the key levels. But I already have formed some sort of a framework or what the market is expecting to happen. In another world, if the market broke below 568 and then it just continued to sell off, that is a week in which I generally would not even participate in the market unless I saw some other clues that would match my criteria. In other words, if we did get down to 560, but the VIX did not spike massively or something, or I saw a massive, hammer candle that formed right at 560 and then the market bounced right from there, that would get me interested. But for the most part, anything below here wasn't really part of my plan. I didn't really see it as part of anyone's plan, to be honest, regarding the way I read the options market or the way I read gamma exposure. So I would have sat out and not really participated. Regarding the approach in which I took, it would have been with these broken wing butterflies because I didn't want any upside risk. To me, options were a little bit too pricey to just buy a call or buy a puts, regardless of which direction I was thinking. This is a way to protect myself from if there's any type of volatility crush, which is generally what will happen after any type of major event. And that's what we see right here at the VIX. Look at how much the VIX dropped. To be exact, from yesterday's close to where we opened here today, this was a 23% drop in volatility. It didn't matter who was elected president. What we do know is that implied volatility was going to decrease, and I believe this is something that I've addressed many times in the past. And within QTA, I answered someone's question last week in which you guys were asking about any type of approach, and I said, and if I remember correctly, I mentioned there's no need to complicate things that much. The one thing we know for sure is that implied volatility will decrease after some sort of earnings event or after some sort of major catalyst. It doesn't mean it won't increase after the event, but for the most part, it will decrease. Even if it just dropped down to here, held here, and then went back up, there's always going to be some sort of decline because the event has occurred. So therefore, the same amount of implied volatility is no longer expected. Running with a traditional butterfly would have opened up risks regarding how far the market would have gone. So I made it broken wing. In other words, I just pulled in this call here. So instead of going with the 58.75 call, I just pulled it in a few strikes to make sure it's broken wing, so there's no risk to the upside. And then the same thing with the NASDAQ. I chose the area in which I think the markets will likely be. This is today's expiration, so you guys can ignore that. The exact trade, if I were to pull it up, is Friday's expiration, as I want to give the market some time in case it needed. But this is it here, choosing the strike price in this case here, thinking it should land around 20.65, so 650. I'm trading the futures options because a lot of this move happened after hours, and I like to take profit before the market even opens. And with TOS, you can't trade SPX options after the market is closed. The great thing too is if you are below PDT, it means you can day trade futures options. So with an account like Thinkorswim, as long as you have at least $2,000 in your account, these types of trades are day tradable, which means if you open this after hours, you can open it before the market opens. I could have opened this trade at 3 o'clock in the morning, close it at 9 a.m., 30 minutes before the market open Eastern time, and the max risk is limited to the downside. So in other words, if after all this analysis, if I was wrong and the market just dropped, I knew exactly what the max risk was on the trade. And as usual, I like to share things in terms of one lots. That way, depending on your account size, you can scale up or scale down, as everyone's account size is different and everyone's risk parameter is different. These are also not the only positions and trades that I have running. There are SPX options, there are MES trades, but I just wanted to showcase to you guys a simple, in my opinion, a simple way to trade, limiting your risks to just one side. In other words, if the market was to go down, creating an opportunity where even with one contract here, the max loss, or in other words, the margin requirement on this trade is under $600, but there is the opportunity with just one lot by Friday to make over $2,000. Obviously, if I went with today's expiration on this trade, there would be the opportunity to make over $2,000 today. So I do still have to decide if I want to hold this until Friday or not. And if the market was to keep going up for this week, the max amount to be made on this would be about $450 or so. Trade costs about $560, and it can make $450. Maybe that's about 80% or so, which for my style of trading, it's a high probability, high odds trade with limited risk to one direction, and it still has the opportunity for some sort of a lotto type win. Is why for this type of speculation, I like to go with broken wing butterflies. That, and also because it's protected against the implied volatility crush. There's probably an infinite amount of ways in which a trader could have taken advantage of this information. With the SPY, half the time, if I think we're going to go to 585 and I see we are down here, I might just click this here, drag this up here, and read the calculation that is showing on the down at the bottom, and this is showing this is a 3% bounce. That means if I'm on the SPX, I'll click here and just drag this up and see where 3% is. 3% would be right about here, so that's 58.70, so that might be the option in which I'm going to target. The same thing if we go to the ES, and I'm thinking about opening up a trade down here on the ES, and I'm going to buy an out the money broken wing butterfly or so, and I'm thinking about buying in this area. I might just click here, drag this up, this is 3%, and that's targeting 5,900. It's as simple as that. I'm letting the system do the math, the calculations for me. I'm paying attention to the SPY as it is my main analysis. I'm trading the ES options, the SPX options. I even have some calls on the MES. And regardless of the instrument, it all is derived from the SPY for me. And here we have it at the start of the week. If the SPY can hold above this zone here, then the target becomes 580. And anything above is essentially just a bonus, especially if anyone purchased 580 calls. I did not buy any 580 calls. It just seemed a little bit too risky to just flat out buy the calls. The butterflies felt safer to me. But I'll leave you guys with that note to maybe go pull up the 580 call, see what it looked like on Monday when we came down to 568. Also take a look at what the 580 call would have looked like when the market was holding above this zone here. And then lastly, take a look at the SPX options at that same time. So if we were to pull up the SPX, and we see if the market was to go to 580, so from here to 580, that is essentially about 1%. That would have been if the SPX was right here. If the market was to go up about 1% on the SPX, that's about 58.14, call it 58.10. Take a look at what that call looked like and see how much that call is up here for today. And then ask yourself, if you caught at least one trade like this every week, would that make you happy? Thanks for watching, guys. Leave a comment down below if you learned something. Like the video, share it, subscribe to the YouTube channel if you haven't already, and I'll catch you in the next one.